Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Welcome back to the Roadmap to Retirement podcast. Today you have a special treat. It is just me, no guest. And if that's not good enough, you actually get to listen to me talk about taxes, which is probably the most exciting topic that any of you could have imagined listening to. So why are we doing this podcast all about taxes today? I think it's one of the least talked about topics of financial planning, or maybe even the most important, probably overlooked a little bit because people tend to get caught up in the investment process or talking about their rate of return and all that kind of stuff. And I'm certainly not going to tell you that's not important, but I think taxes are one of the biggest opportunities for you, the client, or me as the advisor, to make the biggest impact when we talk about the actual financial planning and the end goal of having a better financial situation. So I thought we'd approach this from a couple of ways, and I want to go through it chronologically, kind of the things you should be thinking about as you progress throughout your career and ultimately into retirement. So I want to start with kind of painting a picture of a 22-year-old, maybe right out of college, getting their first job, and they're beginning to make their first tax decisions, although they probably don't know it. And what I mean by this is typically when you get that first job, your employer sits you down, or maybe the HR people send you an email and they tell you all about your benefits package. And oftentimes by default, you're enrolled in your 401k or 403b, and you start saving money on a pre-tax basis, which is the first topic, is a pre-tax basis, which means you've already made your first tax decision. And what you decide to do is save money into this retirement account with the understanding that down the road, when you pull it out, you are going to pay taxes on it. So I would want to urge any of you, if you're in that situation, maybe your kids are in that situation where they're starting their first job, stop there and pause for a minute and think, am I better off saving money pre-tax, after tax, or any other option that's out there? And make sure that you're picking the right option for you. I think for a lot of people, when they're getting that first job, they're probably in a fairly low income tax bracket. And if that's the case, there's a good chance that they're in the 12% bracket. And if you look at the federal brackets, and you can look this up on your own, you'll see that the federal income tax bracket for 12% cuts off a hair under $50,000 a year for a single person. So let's say somebody is making $50,000 a year and they get that standard deduction subtracted off of that. They are in the 12% bracket. And if that's the case, I would argue it probably makes more sense to save money after tax into a Roth account of some kind, acknowledging that you're not getting that tax break today, but saying that paying 12% tax today probably is better than whatever our future situation is going to be. Now, we don't have a crystal ball. We don't know if that's definitely going to be the case, but I think too many young people get in the default of saving money pre-tax when really saving after tax will be much better. And that is a tax decision that they're making, whether or not they know it, that's going to affect them way down the road. So let's have an eye on that. Part two for the younger person is choosing the health insurance plan and how that affects your tax situation. So one of the biggest opportunities that young people have today is to take advantage of the HSA, the health savings account. The HSA works similarly to a Roth IRA, except for it's pre-tax. What does that mean? So money goes in pre-tax, so you're getting that tax deduction to save. Money's going to grow in that account, and you can invest it. When it grows, it'll grow tax-free. And as long as you pull it out for an approved medical expense, it's coming out to you tax-free. So I see a lot of young people, maybe they are in these plans because they have the high deductible plan that goes along with it, and they're taking advantage and they're picking an arbitrary number. Maybe they're putting $50 or $100 per paycheck into the account, which is great. That's a good start. I'm not knocking that, but I would encourage you to max it out. Put the most that you can put into that account, take full advantage of it. And if you're a young person, you think you're Superman and you'll never have a medical expense, good luck. You probably will have a medical expense at some point. So that's the things that young people should be talking about. Now, there's more when you get into buying houses and getting married and filing taxes together, and we can save that for another time for time's sake. What I want to do is switch gears and talk about people that are in the next stage. So they're not retired yet, but they're getting towards retirement. And these are the people that are typically in that pre-retirement phase or the empty nester phase. So if this is you and you're still working, but you probably got a series of raises over the last several years and you're making more money than you were earlier in your career, and you're in your late 50s, early 60s, maybe your kids are out of the house, you're not paying for them anymore, maybe the mortgage is paid off, and all of a sudden you're in a situation where not only are you making more money than you've ever made, but your expenses are probably less than they were 10 years ago. So that opens up a whole other opportunity of, I have this extra money, what do I do with it? Now you might be tempted to spend money on that kitchen remodel or something else like that. But if you are a disciplined saver and you're not interested in doing that kind of thing, you're probably going to look to save more money. So you can max out your 401k, is a great thing to do. Make sure you're hitting the limit there. You can put money into an IRA or a Roth IRA. And we hear all the time, I can't do a Roth IRA and make more money. That's not true either. You can do something called a backdoor Roth IRA. I won't get into it right now. If you don't believe me, give it a Google, look it up. A backdoor Roth IRA is an opportunity for you, no matter how much money you make, as long as you have earned income, to put some money into the after-tax vehicle. From there, if we're still accumulating extra money, don't just let it sit in the bank account. To have money just sitting in your checking or savings account, especially at a local bank that's not giving you a good interest rate, get it working for you. If this is extra money that you don't need, you've already got your emergency fund established, and this is extra money, look to invest it in your brokerage account or your non-qualified account. Get that money growing for you. And then you also create some extra tax advantages on that also. You're creating another bucket of money that's not part of a retirement account. It's taxed as capital gains, not as income. There's a lot of benefits to that. And that'll only help you down the road when your tax planning gets to be more in depth. The next piece of this conversation, moving ahead in the progression of the chronological theme here, is now we are at retirement. So we're retired, and that's where tax planning is a lot more complicated. So you should be considering a lot of things, and I'll run through it quickly because I know we all have a short attention span. But first of all, when are you claiming Social Security? And is your Social Security taxed? So this is a big question too. Is I think if I was in a room full of people or having a conversation with a 35-year-old and I said, hey, is your Social Security gonna be taxed when you take it someday? I think a lot of those younger people would say no, or they wouldn't. Maybe they haven't thought of it before and they think, no, my Social Security is not gonna be taxed. That's incorrect. So originally, when the system was created way back in the day, the Social Security system was designed to not have that income tax when you get in retirement. And then at some point, our politicians decided that wasn't good enough and they had revenue that they needed to do some other project. I don't know what it was, but they decided they needed more money for the government. So they said, hey, I have an idea. Let's start to tax Social Security. And they did. So at that point, they made it so up to 50% of your benefit could be taxable. So if you had whatever, $10,000 of Social Security benefit, $5,000 could be taxable, meaning that would be added to your adjusted gross income. And then a few more years went by and our politicians had another bright idea and another thing they needed money for. So they said, hey, rather than having 50% be taxable, let's make it 80%. So as it stands today, depending on your other income, and this is where it gets more complex, depending on your other income, up to 80% of your Social Security can be taxable. So what that means is if you're retired and you're starting to pull money out of your IRA, maybe you have a pension and other things, you need to first decide whether or not that Social Security is going to be taxable. One, for your own planning purposes, it might be good to know whether or not you want it to be taxable if you have control over it. And two, if it is going to be taxable, we want to figure out if we're withholding the right amount. We don't want to be paying a penalty to the IRS for not withholding the right amount. So consider that. Pay attention to your Social Security. The other sort of tax implication has to do with how is Social Security calculated? A lot of you know this, and I hope I'm not giving you anything that's too redundant, but Social Security is actually calculated based on the 35 highest earning years you have adjusted for inflation. So if you go to ssa.gov, you log in, you can actually see your earning history way back to that first job you had in high school. And based on that, they will calculate and they'll adjust it for inflation again. So if you made whatever, $20,000 in 1980, that's a lot better than $20,000 in 2024. So they adjust for that. And what that means is they're going to calculate based on your income. So if you had some years that were very low or maybe even zero, we run into a lot of people that took time away from the workforce while they're raising a family, or maybe they came to the country as an immigrant and didn't get that full 35 years in. That would mean they have some zeros on there. So one way you can affect that is either working longer to make sure you have your full 35-year earning history, or the reality is a lot of people in today's world choose to work part-time, not necessarily because they have to, but maybe they want to have something to do. And if you're retired working that part-time job 20 hours a week, you're starting to replace those zeros. And you could even be replacing some of those years that you were working full-time but not making very good money. So one easy trick is if you want to increase your Social Security benefit, work a little bit in retirement. With that too, we get into when do I want to claim Social Security? So the kind of the talk you're going to hear if you go to a cookout or you're talking to your buddy down the street is there's a lot of people that are concerned about, I got to take my Social Security as soon as possible at age 60, which just so you know, you can take it from 62 to 70, anywhere in that range. You get a little bit of a cost of living adjustment or a little bit of a appreciation with that. So if you wait a little bit longer, it's going to be a bigger benefit. But anyway, the conventional wisdom is that if I want to get my Social Security, I want to take it as soon as possible because I've been paying into it forever and I want to make sure I get my money. I'm worried about the system running out because I know it's underfunded. So a lot of people make the mistake of claiming Social Security at age 62 as soon as they can. One of the problems with this is if you're still working even part-time, there's something called an earnings limit. And if you have an earnings limit, that means if you go above that limit, for every $2 above that limit you go, they're going to withhold $1 of Social Security benefits. So for example, the earnings limit changes every year. Right now it's about $20,000. So if you earn $20,000, you're right on that limit, you're fine. If you earn $22,000, that means you're $2,000 over the earnings limit. That means they're going to hold $1,000 of benefits, which you probably want to avoid. You avoid that by, it doesn't mean you can't work part-time, but it means if you are working part-time, let's wait until your full retirement age to collect Social Security. Your full retirement age is dependent on the year that you were born. If you're born after 1960, I'll make it easy for you. It is age 67. So that means that if you wait until you're 67 years old, collect Social Security, you have nothing to worry about. But if you claim Social Security before that and you're still working even part-time, now you need to consider the earnings limit. So let's be careful with that. Moving on from Social Security, the other government program that everybody knows about is Medicare. And Medicare has its own kind of tax traps along with it. So we want to be careful with that as well. Medicare is the only type of insurance, or at least the only type of insurance that I'm aware of, where the premium that you pay is based on the money that you earn. So to set the stage, if you think about your auto insurance policy, your auto insurance policy is based on your date of birth, your gender, your driving history, all kinds of things along that line. If you apply for a life insurance policy, they're going to want to know about your health, your weight, do you smoke? But for Medicare, our government program is based purely on the amount of income you have. So once you're age 65, you can go on to Medicare. And when you do, you're going to pay a premium for Medicare Part B and D. Medicare Part A is sort of what you paid for all these years, but B and D have a premium associated with it. And that goes back to the IRMA table. So if you look up IRMA, which is the income adjusted monthly amount, you'll see that, income related monthly adjusted amount, you will see that there's a different premium tied to different brackets. So if you go $1 over a certain threshold, you add another X amount of dollars to it. What that means for retirees is more or less your income is what it is, right? You're not going to sell your house and downsize so that you stay in the IRMA table. But what will happen is you need to be much more aware of distributions you're taking from your IRAs or 401ks, because that money's going to count towards your income. So if I have a big purchase in one year, and this is a mistake a lot of people make, is I want to buy a new house or cottage or whatever it is, and I decide I'm going to pull out a bunch of money from my retirement account to do that, chances are I'm pushing myself into a higher IRMA table. And if I go into a higher IRMA table, now I'm going to have that basically a tax penalty. They call it a surcharge, but it's a tax added onto that premium for that year. And the way that this works, and it's important to know, is it's a 2-year look back. So if you're looking at I'm recording this in 2024. If you're looking at your 2024 IRMA table, you're really looking at your 2022 income, and that's what they're basing it on. I think it's important for people to know that as they approach retirement. So if you're 63 years old and you're going to go on Medicare at 65, which is how it works, if you're going on Medicare at 65, the year that you turn 63 is when you need to start thinking about that IRMA table and making sure that you're not going over a threshold unless you definitely need to. And there are situations where you might definitely need to. So be aware of IRMA. The next thing I want to talk to you about also has to do with Medicare, and that has to do with claiming at the appropriate time. So yes, you do go on Medicare Part A when you turn 65. That's important. You want to make sure you do that. Medicare Part B and D, if you have an equivalent plan through your employer or your spouse's employer, you can choose to stay on that. So a common example here in New York State is the state employees have great insurance benefits. So if you are a teacher or a police officer or something like that, or you're married to one of those people, it might make sense at 65 to go on Medicare Part A, but instead of going on Medicare Part B, stay on that employer-sponsored plan. It might be cheaper for you. It could be better coverage. You need to look into that and make the best decision for you. But what's important to know is that when your spouse or you retire from that profession and now you're going into Medicare fully, you need to make sure you do that promptly. If you don't go on Medicare quickly enough, or you don't sign up on time, they do charge a penalty on that. It is a 10% premium penalty that is enforced for the rest of your life. So once you get that penalty, you're going to continue it forever, and you want to make sure that you avoid that. It gets very expensive. Right now, the Medicare premium is, I think, $174 a month per individual. So if you have a 10% penalty on it, that's an extra $17 per month every year. If you calculate that over a 30-year retirement, it does get pretty expensive. So we want to be cautious of that. The next sort of tax thing, I think this one's very common. This is probably the biggest question that we get from clients is, It's okay, Alex, I've done a great job saving for retirement, me or me and my spouse, however it works out. We've got X amount of dollars in this account. We've got an IRA, a Roth IRA. We've got a non-qualified account. We've got income coming from a investment property. We've got all these different kinds of income streams or different kinds of accounts that we can pull money from. And the question is, which account should I take money out of first? And it is a distribution question. So it falls under two different categories of income planning and tax planning, but it's huge in tax planning. You're deciding which account you want to pull money out of and potentially pay taxes on. So the conventional wisdom, and what we see too many people do, is they say, okay, I've got money in the bank, so let me just go spend through all the money I have in the bank first. It's sitting there, it's not growing, I may as well spend it. Why not? Okay. Then they get through all that money and they say, I've got this IRA or this pre-tax account, and I know there's RMDs, required minimum distributions, coming at some point. I got to take money out anyway. So why don't I spend through that money next? And then once I'm through all that money, I've spent all the money in the bank, I spent my IRA. Now it seems like a good time to go ahead and spend my Roth IRA because it was tax deferred or tax free. I can take it out whenever. If my kids inherit it, they don't have to pay taxes. So it makes sense to wait till the end. And there's some truth to the conventional wisdom. It's not bad per se. The problem is there's of course, a more efficient way to do it. So what we want to do is in some combination, we want to take money out of the bank account, spend that money first, or spend part of that money first. But while we're doing that, we're putting ourselves in a lower tax bracket because we're not showing income on that money we're pulling out. So while we're doing that, we want to be either taking money out of the pre-tax IRA or starting to utilize Roth conversions. Now, what is a Roth conversion? A Roth conversion is the opportunity that you have to take money from that pre-tax account and convert it. Those of you listening, I'm using finger air quotes, convert it to a Roth account. Now, when you do that, it's very rare that you're converting the entire account. If you've got $1 million, you don't want to do all that at once because it's a huge tax bill. But what you do want to do is start to take small chunks, maybe 30,000, 50,000, and convert those over into a Roth account. The advantage of doing that in this distribution strategy, while we've got lower income than normal, maybe we're living off the money in the bank, like we said in our example, by doing that, we're converting in a lower tax bracket. So if you have the opportunity to convert it, say 12% with the current tax rates, if you can convert $50,000 at 12%, chances are way down the road when you start to need that money and you want to pull it out, it would be at a higher rate than 12%. So let's get into the Roth account where we never have to pay taxes again. That does, of course, require you paying more taxes today, but to save a lot of taxes in the future. So it's a good strategy for a lot of people. It's a little bit more complex than that. So if you have questions, that's something your advisor can help you out with, hopefully. So the next tax strategy I want to talk about is it's only really relevant to people at a certain age. So it's called a QCD or qualified charitable distribution. And it's one of the best kept secrets in the IRS tax code. Unfortunately, it's only available for those of you that are over the age of 70 and a half. And I'm talking a podcast right now. So I don't know if that's my primary audience, but if you are listening to this, good for you. But once you get to the point where you're age 70 and a half or older, you now qualify for the QCD, qualified charitable distribution. The way this works, and I'll try to illustrate the best I can verbally for those of you listening, is you're able to take money from an IRA. When you take it out of the IRA, it is qualifying for your RMD or part of your RMD at least. And it's going directly to a charity of your choosing without paying tax. So a really easy example is, let's say I want to give $5,000 to my favorite charity. I do it every year and I'm age 70 and a half. Now I can take money directly from my IRA, have them issue a check in the name of the charity. So the money's going to the charity. And by doing that, I'm saving on taxes. So I'm not paying any tax. I'm taking $5,000 direct rather than taking a larger distribution. Instead of trying to net $5,000 of taxes where maybe I have to take out $6,500 to net $5,000. I'm paying $1,500 of taxes. We don't have to do that. So we're saving $1,500. We are satisfying our RMD and we're giving money to the charity of our choice. And I think the feedback we get from people on this is that they're probably in the routine of giving to a charity anyway. And it used to be in previous tax codes that they could get an itemized deduction for it. And although you still can use an itemized deduction, the standard deduction that's available is so large at this point that most people aren't able to exceed it. So if your standard deduction is roughly, let's call it $30,000, and you want to give $5,000 to a charity, that means you need to come up with another $25,000 of other itemized deductions just to get to the break-even point before it really starts to be financially advantageous to you. Now, all that being said, you're giving to a charity for a better reason than just, the tax break. Hopefully you're supporting a charity you care about. But if you're going to support a charity and you want to receive some kind of tax break for doing it, the QCD is a great solution. So take advantage of that if you can. And if you're not 70 and a half yet, file that away. And maybe in a couple of years or a bunch of years, you can still do that. The next strategy I thought we'd go over, and I respect your time, I don't want to go too long here, is talking about the step up in basis strategy. So this is applicable to any non-qualified assets. So that's, again, you've heard me say this before, there's a lot of different names for those accounts. It could be non-qualified, it could be a brokerage account, it could be a taxable account, a joint account, it could be, what am I missing? I said taxable, all those types of accounts. So they're really just accounts that are not part of a retirement package or retirement plan. And the way that those work from a tax perspective is you have capital gains tax. You do not pay income tax on it, you pay capital gains tax on it. The important thing to know here is when somebody passes away, you get a step up in basis. So let's say I invest $100,000, it grows to $200,000, and then I turn around and sell that stock. Now I have to pay capital gains tax on the $100,000 of growth. But if I die and it's inherited by my kids, they get a step up in basis, which means that they get to inherit the cost basis based on the fair market value of the date of my death. So if when I die, that account's worth $200,000, their new basis is $200,000, not the $100,000 that I bought it for. So this is important when you think about estate planning or positioning your assets for the next generation, is you want to make sure that things are set up for them to inherit it. So you don't want it in a joint account. If you're leaving money even to your spouse, you don't really want it in a joint account. You want it to be in the name of the spouse who's likely to die first. And sometimes you don't get to know that, but a lot of times you do get to know that and take advantage of the step up in basis. Same thing is true if you're passing money to your children. Same thing is true when we think about distribution planning. So the previous example I gave, but if you're deciding which account to start to pull money out of, maybe it makes sense to pull money out of your IRA, paying tax on it, because the non-qualified account that you also have, that other investment account, you know that when you die, your kids can get it tax-free, and maybe that's more important depending on your situation. The last example I want to go through is talking about inherited accounts that are not these non-qualified accounts. So inheriting an account that is a retirement account. So if I inherit an IRA or a Roth IRA, how is that treated? On both those examples, they've changed the rules recently. So it used to be that there was something called a stretch IRA. So you could inherit a 401k or an IRA from, let's say, your parents. You inherit the account. Now, rather than having to be forced to take distributions, or when you inherit, you're going to be forced to take distributions in some form, no matter what. The old tax code allowed you to stretch those distributions over your life expectancy. So I could literally inherit an account and draw it out for decades. I could take a small percentage out every year, and that would satisfy the RMD. The new tax code that we've been dealing with for 6 or 7 years now requires that you take all of the money that you inherited out of that IRA and you do it in a 10-year window. They're not perfectly clear on how they want that to look at this point, but as of right now, you can take it out anytime in that 10-year window. You will pay tax on it when you take it out, of course, but it allows you, or it really robs you of the opportunity you had previously to stretch it out, and now you've got to do it a little bit quicker. You don't want to not do that. There's heavy penalties for not doing it, but you got to get it done. One mistake that people make is they say, oh, I inherited an account 10 years ago, or I guess not yet because the rule hasn't been around that long. But one mistake that people could make is they inherit an account, they wait until the 10th year and they take it all out at once. And now they've got a very big tax bill because all of that money they're pulling out of the account is added to their taxable income for that year. And if you look at the tax brackets, you can figure out pretty quickly that they're going to walk away with very little of that account. And I think that's where I want to cut it off. I feel like we've gone pretty long. I respect all your time again. So thank you for listening. I hope this has been a helpful kind of overview of taxes. I can tell you that taxes do get more complex. So if you've heard me say something that you think is important or you might have questions on, reach out to myself, reach out to another advisor you know, and have them go through your situation specifically. We never want to make too broad of advice and mislead anybody. So thank you for listening to the Roadmap to Retirement. I hope you've enjoyed listening. I hope you learned something, and we'll talk soon. Thanks. Bye.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.